Well, Aura Fund Managers specializes in capital preservation funds and co-manages the Sanlam Unit Trust Funds. Eugene Goosen, Portfolio Manager at Aura, joins us from our Cape Town studio to share his outlook on the investment risks and opportunities that currently exist. And Eugene, I've got to start by asking, do the risks outweigh the opportunities with all this uncertainty out there right now?
Well, I think the simple answer there is that we're living in challenging times. One should be very careful not to let the risk overshadow you, and you've got to be very careful what you do, how you do it, and when you do it. And I think the when you do it is the big problem. It's the timing, because we're having such huge market volatility. Trying to time the market in an environment like this is exceptionally difficult.
Yeah, I mean, Eugene, I've got a question. I mean, you've hit the nail on the head. Very, very difficult at this particular point in time, especially with all of the volatility that we're seeing in the market. And we've almost had this disconnect between where our local markets, in particular our equity market, has been trading and where some of our global counterparts have been trading. With that kind of backdrop, timing does become quite key. And I know a lot of practitioners out there speak about asset allocation as a strategy that they use over a longer time frame. But even within that framework, let's assume you're having an investor coming in right now with, you know, his 100,000 rands. He's so sensitive to timing, in particular to the application of that money to the equity market. Your comments on that and how you'd look at approaching that given the current context we have in the markets.
Yeah, well, I think your starting point is you've got to look at the global picture and understand the drivers. Our equity market in general is driven currently, or over the past 2-3 years, by foreign events. The local side, you get specific events. Let's take, for instance, Exoro, where a foreign company made a trading statement. It flows through to one of the subsidiaries and the stock gets knocked like hell. But in general, it's macro events driving our market. And I think the entry and exit points into the equity market or any other asset class, it's so essential to understand the macro side and the potential of the macro side and what could evolve over the next, say, 6 to 18 months. Just looking at the European situation, you know, it's the same thing going on and on and on. Every now and then you get a bit of a positive spur, but you've got to be careful not ignoring what's happening on the other side of the ocean. What's happening in the States? Are we seeing stability in the housing market? Are we seeing price tick-ups? Why are we looking at that kind of thing? The drivers of the equity market currently is either New York or the London, especially the hedge fund or the emerging market funds.
I want to put that question, Eugene, before we move off the US, I want to put the question you've actually just asked. Are we seeing stability in the US housing market? What's your opinion on that?
Yeah, I think we are. I think we're seeing a little bit more than stability. Remember, the crucial point in a market environment that we're experiencing now is consumer confidence. It's everything about consumer confidence and what evolved. And if you look at the size of the US market and the US consumer, there are a couple of critical factors that drives this consumer confidence. Balance sheet, extremely important. In other words, balance sheet, simply equity and property. The equity side, I think, is okay-ish. It has performed reasonably over the past 12 months. Say they're up on the S&P 10% over the past 12 months. Property side has been dismal. What we are seeing is that stocks in the housing market is normalizing, and I think it's getting to reasonable levels. And then very importantly, linked to that is the pricing in the housing market. So let's focus on single family units. Seem to have been flattened out. It is slightly down on the last number to a year ago, 0.6 or something, but it's flattening out and we're seeing some stability. And the affordability of housing is as good as it's going to get for a very, very long time. So the flow through there is the jobs market, because the housing market is still, to a great extent, caused the vacuum in the US jobs market. A huge amount of jobs were sucked out of the system because of the collapse. And
Eugene,
I think the acceleration of this market will slowly add jobs into the market. And that is sort of completing the main driving factors on US consumer confidence.
Eugene, I mean, obviously the US consumer there, or the consumer segment within the US, making up close to around 70% of their economy, so very important. You've touched on 2 points in terms of the consumer's equity that they have in their balance sheet. One obviously being the equity market, which in my opinion is actually the smaller of the two. The other being the housing market in particular. And Bronwyn, a large component of the consumer's wealth is tied to that housing market. Again, tend to agree that we're seeing some sort of normalization coming through into that market. But the question I'd like to pose to you as well is that, we're particularly concerned that there is the potential for almost a shadow inventory of houses that are still sitting there in the back of the system. And as that market rationalizes, that could still give you a little bit of an overhang with regards specifically to US housing. But then also, more importantly, we haven't touched on your views on China. I mean, a lot of the market banking on a Chinese recovery story, and it's actually been quite the opposite. We've seen the Chinese slowing down quite considerably. And then, the spill-on events for South Africa would be that if China starts slowing, the resource-intensive sort of growth that we need as South Africa also tends to dissipate somewhat. Your views on that?
Okay, so let's focus very quickly on the US housing market and especially the inventories. And you're quite right. I think the inventories was the big issue. There's a lot of defaults, or a lot of default occurred, which flushed the market with this enormous amount of properties for sale. And it seems as if this thing is stabling down, and the level, and we can only work on the numbers that we're seeing, the level of inventories is down substantially. The amount of new housing starts is down substantially. So the capacity of the market, I think, is tilting towards improvement. We're not saying heydays, we're not seeing housing prices accelerating like hell. All we want to see now is stability in house prices, and still that the affordability side is acceptable. That will flow through into the confidence side and slowly into the jobs market, very slowly. Now, linked to that is obviously China. Now, I'm not the greatest China bull. I think if we look at China and you look at the amount of as a percentage of GDP that capital invested in the country, it's not sustainable. I mean, you can't, 40–50% of your GDP can't be capital investment. Over time, that thing needs to come down quite aggressively. So we are going to see that, and we're most probably going to see a more consumer-orientated market there, and we most probably over the next 5 to 10 years going to see that market coming down to, say, a 5 to 7% growth
Eugene,
rate.
do you buy into,
yes,
just to bring you back to the local environment, do you buy into the story that we are faced with a low yield environment across the board for the next 5 years?
Quite possibly. Maybe 5 years is a bit long. But if you look at the balance sheet problems that we have in Europe and in the US, it will benefit these countries in general to keep rates very low to fund themselves. The question that we've got to ask ourselves is, at what stage will inflation come through? And when it happens, will it be another bubble? Most probably yes, but I think we're going to see a fairly low interest rate structure for extended period. The European problem is not going to go away over the next 3 to 5 years. There's always going to be an underlying problem. The States is maybe slightly shorter, but not much. So interest rate wise, I see reasonably low interest rates for most probably next 3 years plus. Our cycle will most probably turn, I guess, over the next 18 to 24 months.
Eugene, just a quick question to try and bring it back to home, and probably one of the most topical issues for local investors is the rand and your view on the rand. I mean, there's lots of talk. I mean, we just touched on inflation now, with the rand being the key risk. If we see a rand blowout to inflation coming through locally, what is your view on the rand? Let's call it over the shorter term at first, and then also over an extended time period.
Okay, so if we look at the shorter term and we look at 3 months, I'm going to tell you, I haven't got the faintest idea. It's impossible to forecast the rand over a really short-term period. If we move forward, the critical factors that's going to drive the rand is most probably what's going to happen in the States and China. We know Europe is going to stay placid for extended period because the rand and commodity prices are crucial in this whole story. From a theoretical point of view, we know our relative inflation to the US, if we look at rand dollar, is higher, so we should expect a weakening of the rand. I think what I am cautioning is that we've got to be very careful that we simply assume a weak rand because of the hoo-ha that's going around us, and 12, 18 months from now on, we're seeing a little bit more stability and maybe a bit of a pop-up in commodity prices.
On the commodity prices, Eugene, platinum stocks, high risk but difficult to time. Should we be buying across the board plenty of platinum stocks right now, sir?
You know that I've been wrong on platinum for the past 3 months. I believe you should really start accumulating platinum. We know it's a late cycle metal, as copper is, but I think the sector is so shot. It could most probably get even more shot, but they're cleaning house very aggressively. And if you look at the earnings downgrades that we saw in the platinum sector and the potential, if you get the slightest turn in growth in Europe, the States and China, then you are going to see a bit, you're going to see a re-rating in the platinum stock. So it's maybe not in 6 months' time, maybe not in 18 months' time, you don't know. So I would accumulate, yes.
And then bringing it back to today's news flow, just a quick comment on Exxaro and the potential for investors going forward with good results out from the company today.
Yeah, we knew what's going to happen with Exxaro. Okay, so Exxaro, if you simply look at their contribution to their NAV from via Kumba, Sisha 9, and you look at Tronox, then you're buying the coal assets basically for nothing. I would guess it's at the PE of anything between 2 and 5 times. So I think the company is really, really cheap, but it is risky. We've seen iron ore coming down quite aggressively, and the mineral sands business is very difficult to forecast. If you just look at comments from DuPont and other big companies, they see reasonable stability, but itchiness on the Chinese side. And are the US guys going to paint their homes in the next season? You know, it sounds silly, but it's very important for a company like this. So I like the company.